Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, today we're going to talk about Fannie Mae's home index price report that just came out. This covers the third quarter. So we're now in the fourth quarter of 2023.
We're in the fourth quarter. And if you got a chance to go out there and see the eclipse today, good for you. Hope you had your fun glasses on so you didn't hurt your eyes.
Yeah.
Because we are bright, but we're not quite as bright as the sun.
We just walked in from the eclipse. Show of hands. Raise your hand if you live in Vegas and you were watching the eclipse. I'm going to count all the people. Okay, that's about a third of the people went out there. Unless you had like the glasses. So 6 years ago, we spent like a whole week. We drove up to Idaho with some friends and we camped out and everything. We lived in the camper for a week. And it was just to be in totality, which is a completely different experience. If you've never been in totality in eclipse, meaning 100%, it's absolutely like life-changing. And it was for 2 minutes and 9 seconds we were in totality. But it was totally worth it, like the 1 week adventure. It was this 12-hour drive to get up there.
Yeah.
Okay. On to the Fannie Mae report. So all this data is online. You can go look at it. It's very cool. Okay, home prices remain resilient, rise further in third quarter. We're going to go through this whole article. Home prices are resilient despite interest rates being more than double. And I want to talk real quick before we get into the data here. How is it that, we've had a year of home prices or of interest rates at 6.5% to 7.5%.
Correct.
So this idea that as soon as rates get to like some number, the housing market would somehow collapse. But why, even in a year, home prices have still been going up? It's not like, it doesn't seem that interest rates are having an effect on prices, not affordability, prices.
Right, so they're not having an effect on prices because the name of the game is inventory, right? So long as we have really low inventory levels, supply and demand dictates that sellers will not take a haircut and buyers are willing to pay what it takes to purchase these homes. The other thing is, you're right, it is impacting affordability. So what that's doing is it's shaving off the bottom third of buyers, but you still have 2/3 of buyers, right? And then you still have all the people buying cash for various reasons, either because interest rates are high or because they're trying to park cash as an investment or hedge against inflation, whatever their reason is. So all of these things put together bring us where we are today, which is resilient home prices and modest appreciation.
Okay, here's the first piece of data from the article. Washington, D.C., October 13, 2023. Single-family home prices increased 5.3% from quarter three of last year to quarter three of this year, up from the previous quarter's revised annual growth rate of 2.9%, according to the Fannie Mae latest home price index. We'll talk about the index in a second. A national repeat transaction home price index measuring the average quarterly price change for all single-family properties in the U.S., excluding condos, on a quarterly basis. Home prices rose a seasonally adjusted 2% in quarter three 2023, deceleration from 2.1% growth in the second quarter. On a non-seasonally adjusted basis, home prices increased by 1.7% quarter 2023. Indexed is different from median.
Right.
Median can be inflated or deflated based on the numbers of sales in the high end or low end. Yeah. So
and the mix.
And the mix of sales. So give an example of what that means exactly.
Okay, so so this is one of your favorite examples where a house houses sell for 300, 400, 500 1 year, and then the next year, the same exact houses sell for 400 and 500. So then, so the first year the median was 400. The second year the median is now like 450. And does that mean that home prices went up 50,000? Well, not necessarily, because the other one dropped off and it never came on the market. So
yeah.
So that's why that's a little trickier to look at. But the index, I think, is a more accurate picture of what's actually happening in the marketplace.
So what happened in last year in the fall was we had way more transactions in the lower end. Mm-hmm. So home prices appeared to decline substantially, but indexed home values only fell 3%. Mm-hmm. Like in Vegas, they fell 3%, even though the median in Vegas fell 8%. But that's because the types of homes that were selling were lower end homes. So you didn't have the $600,000, $700,000, $800,000 houses, stuff above median selling as much. So home prices median was down more, but the indexed amount, the actual value of specific homes, was actually less.
Right. This is also helpful when you're looking at averages, because like when we sell homes that are 11 million, 20 million, something like that, that's going to totally screw up the averages, right? So an index is a much more accurate picture of what's happening in a marketplace.
Okay, here's another quote from the article. Slightly slowing housing price growth may reflect in part the affordability impact of the higher mortgage rate environment. So higher mortgage rates are impacting the market. They're keeping home prices from going up even more in this inflationary environment, okay? Even though prices were still solidly higher this past quarter than a year earlier, said Doug Duncan, Fannie Mae Senior Vice President, Chief Economist. We're now in the fourth quarter when house price appreciation typically slows, and with interest rates both higher and more volatile, it would be reasonable to expect some additional slowing in price appreciation. But the ongoing supply problems continue to drive the larger affordability challenge. So home prices are going to go up in the fourth quarter, predicted, not as much,
right?
Because of high interest rates.
Right. So this is something that we talked about before, where I said, hey, what would actually help with the rise in home prices is higher interest rates. I wasn't very popular when I said that, and I kept saying that for a few months over the summer, because that's exactly what it does, is it pushes out some people out of the market, which means there's less competition for the low inventory that we have, and actually helps with slowing down the increase in home values. Now, if you're a homeowner, maybe that's not to your liking, but at the end of the day, a stable market is helpful for everybody. Look, these markets where we've had 20% appreciation, they're great if you're selling, but generally if you're selling, you're also buying, so it's kind of a wash, right? So the only people that really helps are the people who are just taking money off the table altogether and doing something else with it.
Okay, here is the Fannie Mae chart. Now, there's two things on this chart. First of all, on the bottom, you can see it goes all the way back to 1975, which is about when Fannie Mae started tracking this data nationally. The numbers on the left are the home prices, basically, right? So you can see back in 1975, it looked like a median home price was about 40 grand in the U.S. And you can see how it went up to 200 and then it dropped a little, and then now we're up at like 3 something, right? Over 300,000. So that light blue line is home prices. The dark blue line that's jumping around is the annual rate change. That's not the prices of homes, that's the annual change. So if you look way down there on the right-hand side, you see 0%, you see -6, -10. You see the 0%, and then every year where we are above 0% showed an increase in home prices. Well, if you look, we haven't had a decrease in indexed home prices since basically like 2010, 11. Okay? And if you look all the way to the right, you can see the little uptick, how the home price appreciation has increased from last year. That's what we just read in the article. And then you can see the little blue line. And then, of course, it tells you on the top what those are, year-over-year change in the home price index. When you look at this chart and you step back, this kind of shows you that home prices pretty much just go up, like, right, over time.
Over time,
all
yes.
other things being equal,
yes,
home prices are going up, whether they beat inflation or not. Who knows? But remember, inflation, except for 2 periods now and in the 80s, has been basically 2%. Home prices tend to go up 5% a year.
Right. So, I just want to clarify something. The fact that in the third quarter, home prices didn't appreciate by as much as in the second quarter, that's to be expected. We've talked about seasonality, and the same thing for the fourth quarter. Regardless of what interest rates are doing, traditionally, home prices start to slide in the third quarter and fourth quarter, and then start picking back up in the first quarter. It just has to do with the seasonality. It has nothing to do with interest rates. It has nothing to do with anything else. Right now, it just happens to be coincidental.
Here's another chart. I got this off Redfin. This is nationally. This is 5 years. Now, I don't know where they get their data. So, and all these charts tend to come from different data sources, but this is the number of homes since basically 2019 available for purchase, homes on the market, okay, for sale. They're saying there's 1.5 million. But if you look back, even last year, there were almost 2 million at one time. We're still below the peak of 2021 when there were probably 1.7 million homes on the market. 2020, 2 million homes on the market. 2019, at one point, there were about 2.4 million homes. This is on the market at a specific time, right? Those peaks are probably this time of year. October is generally when there's the most number of homes on the market. And you can see if you look at those peaks, which are basically today, last year and all these other years ago, we're way below where we were those other years. And the other thing you'll notice is if you look at the peak and then move to the right, that the inventory drops from this time of the year. And you could see where are we going to go from here? Because if inventory drops again, no, that's not going to do anything to help affordability because home prices aren't going to drop because inventory drops. If anything, it becomes more competitive.
Right. So what do you think?
Yeah.
What's happening in your market? Are you watching from Vegas? Oh, you got more charts?
Yeah, I've got another chart I want to show them here too.
I missed it. Sorry, my bad.
She missed the chart. I got to find the chart. It's pretty cool. Okay, here's the chart. Now, you're probably saying, Todd, this affordability, how can the average person, how can a person who only makes $40,000 a year afford to buy a house? Well,
so first of all, that's not the average. We start there.
Yeah, the average is 70,000 a year is the average family income. We also know that 42% of all homes are owned free and clear.
Right.
Okay, so those people don't. Everyone else actually found an interesting thing. Only 1% of all homeowners have over a 6.5% interest rate.
Right.
Everybody else is either free and clear or they got a loan so long ago. All these people with super high things that are going to get foreclosed. It's 1% of the market. Even if every one of them got foreclosed, that would be the normal foreclosure rate. So you'd have to have every person with a 6.5% loan get foreclosed. Here's the other thing. A lot of those people, almost none of them are 100% down. 100% loan to value. All those people had to put 20% plus down for the most part. So if you put 20% down and now your home is maybe not as affordable as you hoped it would, what do you do? Do you just let the bank take it back and give away the $150,000 you put down on it?
So here's the thing. Something would have had to have, some circumstance would have had to have changed in your life because you were qualified for this loan amount. You were clearly okay with this payment. So some circumstance had to have changed. So it's not even everybody. It's somebody who's had a life circumstance change. And those people are going to either find some way to deal with their life circumstance, or they will go ahead and put the house on the market and sell it. They have equity, so there was enough money there for them to pay all their closing costs and put some money back in their pocket. They may not break even. So I want to make that very clear that let's say that you paid $500,000 for the house, you put $100,000 down, and you got transferred, whatever, and you need to sell the house, and you're going to sell the house for pretty close to what you bought it for. Let's say you sell it for $490,000, and you've got closing costs and whatnot. Are you going to get all your $100,000 back? No, but you will get some money out of it, even after paying all your closing costs. So that's an important thing to note, is that just because you don't sell the house for what you bought it for or more, doesn't mean that you don't have any equity and that you don't have any proceeds at closing. You do. You just don't have what you would have liked to have had.
Here's the thing I think the crash bros are missing. In 2006, 70% of all loans were two things together. They were some sort of weird adjustable rate that adjusted after like a year to a higher rate, and 100% or more loan to value, meaning you were borrowing $350,000 on a house you just paid $300,000 for, because the $50,000 was to like make repairs in these kind of weird loans. So it didn't. And what people would do is pocket the money, right? And then they would say, "Oh well, the house isn't worth $350. I owe $350. It's only worth $300, and interest rate just went up, and now my payment's $2,400 a month, but I can only get $1,200 of rent. I'm just going to let the bank take it back, right?" That was the normal.
Right. So I remember people actually purposely doing that because they wanted to buy a boat or they wanted to, do whatever with the money. So they would actually go out and buy houses, never intending to make a single payment on them, just wanting to suck money from a loan that they knew that they'd walk away from and do something else with the money. It was an interesting time.
And you could say, "Oh, but that's got to be illegal." Well, actually, it's not. In most states, it's not, because you could take a home equity line out or something on your house in a lot of states and use that money whatever you want, and then let the house get foreclosed, because most states have what's called a single action. They can only take one legal action against you. Foreclosure is considered that action. So they can't, in a lot of states, they can't also come after you for a deficiency. Okay, Nevada's one of those states. I actually door knocked people that got foreclosed that literally admitted to me that their attorney told them not to worry about it, not to file BK, just to let the house be foreclosed, and that the most that would happen to them would be they would get a 1099 from the IRS for the deficiency, but then on the tax form, they just put it was a primary residence. They have to pay taxes on the deficiency even.
Right.
Okay? All right. So in 2008, that was the norm. Today, it's the outlier. Someone with a 7% loan that put a small amount down is the outlier. It's a very, very thin number of people. So almost nobody existing that has a house is selling, because most people who sell also are buying. So that's choked off both sides of supply and demand. Interest rates have done that, okay? And maybe home prices have it. You're saying, but home prices, Todd, these home prices are crazy. Nobody can afford this. Juana, what do you think? Name the top two most expensive housing markets in the U.S. What two cities are like the most expensive?
Well, New York City would be number one.
Oh, let's just stop right there. New York City, the most expensive in the U.S. Like, if you wanted to buy a place there, it's probably $1.5 million for a condo.
Yeah, I mean, if you want a bathroom, that's probably extra, but yeah.
Okay, so you're saying, and then the rest of the country is relatively affordable compared to New York City. Well, let's look at the rest of the world. This is the home price to income ratio. It's 5 times higher in Shanghai than New York. Meaning you have to make 5 times as much income in Shanghai to buy a place than you do in New York City. Where else is it more expensive? Shenzhen, Hong Kong, Guangzhou, Beijing, Mumbai, Hangzhou, Seoul, Milan, Paris, London, Sydney, Singapore, Tokyo, all more expensive than New York City. These are countries all over the world. They're in Asia, they're in Europe. New York City's relatively cheap. You can buy relatively cheap. Matter of fact, a bunch of people from the Middle East have come to New York City to park cash because it's so inexpensive compared to the rest of the world. They're buying up luxury, they're buying up high rises basically. And then, of course, if you were to use the rest of the U.S. after this, we know that Canada has median home price in Canada is 1.2 million. It's 3 times as much as the U.S. We're just over 400,000.
Right.
So we're used to this very easy, oh, you can buy a house. It's only, 25% or whatever of your monthly income, appreciate, yada, yada. And now that it's getting squeezed a little, everybody's freaking out. But it still hasn't affected home prices. And Fannie Mae apparently doesn't think it's going to.
Right.
And I don't think it's going to either.
No, look, people are industrious, people have income, and people can afford payments. Now, does that mean that you can afford the house that you could have gotten a few years ago? Probably not. Okay, because the house that you could have gotten a few years ago for $500,000 is maybe $700,000 now. So no, maybe you can't afford it, but you can afford a house. Just maybe not the house you'd like. Look, I would like to be 24. That's not happening.
You're not 24?
No. And that's not happening. And we just kind of work with what we've got. Maybe I would like a $10 million house, and that's not happening. So those are things that we all kind of have to adjust. But there's a difference between adjusting to a different product versus not being able to buy a product at all. So these people that are saying, hey, nobody can afford houses, well, clearly that's not the case because transactions are happening. What is happening is that people have to adjust their expectations regarding which house they're going to be able to purchase.
Right.
All right. Now are we done?
Yeah, that was the last chart.
Okay. Okay, now we're done. For real. All right, so like the video, subscribe, hit the notification bell. You know the drill. And leave us comments. What's going on? I love the comments where people tell us what's happening in their market, particularly when you're watching from someplace really interesting and you're with this chart where we're comparing home prices in the U.S. with other cities all over the world. I think that's really interesting. What's happening with the appreciation where you live?
You know what? It's interesting. It's one of two things.
What?
It's either anything that goes on the market disappears in a day.
Yeah.
Or it's, stuff's not selling here. Inventory's starting to build up. Because there's certain markets like Austin or places like that where home prices shot up so much And then now there's a bunch of people trying to cash in on it. And there are other markets like Miami where the inventory is still really tight. Stuff sells pretty quickly.
Right.
Yeah.
So, one of the things to watch out for, and I'll wrap up after this, is when institutional investors are selling. And that's probably something that you can kind of check out because, for example, if Open Door is listing homes, then they're an institutional investor. So you can kind of see those. So those are kind of interesting to watch. But we're not seeing that right now. Just because of diminished inventory, that doesn't mean that they're not bringing homes to market, but that they're not bringing them to market in mass, right?
And
there's a difference.
Rent prices are still pretty solid, and there's not a lot of vacancy.
Right.
Rentals disappear pretty quickly, relatively quickly.
Right. I mean, we're getting into time of the year where things are going to be much slower for rentals too, because people don't want to move over Thanksgiving and Christmas and that sort of thing.
Yeah.
And same thing with home sales. You're going to see homes come off the market. So this is kind of a transitional period, as I like to call it, over the holidays. So it'll be interesting to see what happens after the first of the year. Like the video, subscribe, hit the notification bell, leave us comments, and share the video. We'll see you on the next video. Bye.
Bye.